Alright gang, welcome everyone. This is the first part of managerial accounting. First video I wanted to actually review some things from ACC 201 from the financial accounting class, particularly for the folks who took financial accounting, may have taken it a long time ago and the concepts aren't all that fresh. So wanted to make one quick video just to review what was learned back in financial accounting. And one of the things that I've posted on the Chapter 1 PowerPoint and lecture videos page on Web Campus is some handouts, and I want to just show you what those handouts are. The one you're looking at on the screen here is the first one, and this talks about and shows what each account type is and their normal balance. So in other words, assets have a normal debit balance, liabilities have a normal credit balance, owner capital has a normal credit balance. So on and so forth. You can see what the normal balance for each account type right under it. And I've also listed here to increase each account type, you do what is above or do whatever the normal balance is. And what I mean by that in real simple terms is, let's take an asset for example, which has a normal debit balance. If I want to show an increase in an asset account, I would debit it. Whatever the normal balance is, I do that as well. To decrease each account, I do the exact opposite. So if I want to show a decrease in an asset, which is a normal debit balance, I credit that asset account, and so on and so forth. Hopefully you guys remember, if you took this class with me, you will remember this slide both with affection and with terror. It is the lifeblood and the most important slide you will need. It explains basically how to do every sort of transaction and how each journal entry should be recorded. So please keep this handy. This is handout number 1 that I'm handing out. This is handout number 2. It basically shows inventory systems. We're going to go over this in detail, and this will become very relevant for this chapter, this semester, especially chapters 1, 2, 3, and 4. And what it basically is a graphical design of an algebraic formula. And what it says is that whatever is in beginning inventory, if you add any additions, add those up and you will have the total inventory available for that period. If you subtract from that the ending inventory, what remains in ending inventory, you can very easily calculate the reductions in inventory, or vice versa. If you know what the reductions to your inventory were, you can very easily calculate what your ending inventory should be. I'll give you a quick example, and I do want you to get comfortable with this slide. Keep this handy as well. Beginning inventory, let's assume we have $1,000 of inventory, and we go and add another $1,000 of inventory. If I were to ask then, what's the total inventory available? Very simple, correct. It's $2,000 of inventory, right? The beginning inventory plus whatever we've added to that inventory. Now, if we had $2,000 of inventory available, and we go take account at the end of the period and there's only $500 of inventory left, well then we know that our reductions in the inventory must have been $1,500, right? Or let's take another example. If there was $2,000 of total available inventory, what we had in the beginning and the additions, $2,000 still, and we know that we got rid of, let's say, $900 of it, well, we should have in our ending inventory, what remains is then $1,100. This is a really simple concept, but it's going to drive a lot of what we do, and we will, of course, complicate it quite a bit this semester. So please review this as well. And the last slide is something that's going to be new. This is not review stuff, but things that we're going to actually work on in Chapter 1. It's a schedule of cost of goods manufactured, which is a little complex. You don't need to have that handy during the Chapter 1 review slides that we're going to do in just a moment. But you will want to use this. This will help during the Chapter 1 lecture, and it'll help you with the Chapter 1 homework. So helpful hint, have this stuff. I advise, if you have the means, please print out the handouts before all the lectures. If there are handouts, I will post them there, and not every chapter is going to have handouts. But if you can, print them out ahead of time and have them handy while we go through the lecture videos. It should help with understanding these concepts. But for the financial accounting review that we're going to do now, you definitely want to have that slide number 1 and slide number 2 from the handouts that were posted. So let's go ahead and jump right into the financial accounting review. And this isn't going to be in depth. We're going to go through it pretty quick. I just want to review the concepts. So remember that financial accounting is based upon this one accounting equation, right? And that is that assets is equal to liabilities, which is what the company owes to outside parties, and equity, which is what the company owes to its owners. So basically, assets is equal to what the company owes, both to its owners and to people outside of the company. Double entry accounting and generally accepted accounting principles, which is everything we do, requires that this accounting equation always remain in balance, and we want to consider the effect of every business transaction that happens to our company in terms of this accounting equation. So let's go over basically what assets are. We all know what cash is, we know what equipment is. Accounts receivable probably requires a little bit of review. Remember that if you are a company that does business with other companies in particular and customers on a normal basis, a lot of times if you're going to have integrated business processes where you're either selling services or products to your customers on an ongoing and regular basis, particularly in high volume, they may not be sending you a check or cutting you a check or paying you cash or whipping out the old credit card every time you do it. If you've got a business relationship together, you may just put it on their account, right, and bill them later. If you've got a customer that owes you for either services rendered or for products that you've sold to them, you will have an account receivable, meaning if you were to sell them $10,000 of your services, they owe you $10,000. If they have not paid it, there would be an accounts receivable of $10,000. Remember, that is an asset. That's something that the company owns, a resource owned, which will provide a benefit in the future. In our example, our company will be collecting $10,000 in the future, right? And we do have a legal right to collect those monies. If they don't pay up, we can sue or pursue other avenues. Land and buildings, I think, are pretty self-explanatory. Remember, supplies are small things that the company uses first when we purchase them, and then we slowly use them up. Office supplies, other business supplies. Prepaid expenses we'll discuss in just a bit, but that's basically where we're paying something like rent or utility or insurance are the typical examples. But we pay them far in advance. So in other words, if we were to pay last month's phone bill, well, that of course would be an expense immediately when we pay it out, right? But if we were paying, let's say, rent for the next 2 years, well, if we're paying for stuff in the future that's going to give us a benefit in the future, when we pay out that cash for the rent, it's not an expense just yet, right? Instead, we're exchanging our cash for an asset once again, the right to occupy and use the premises. And as we slowly use up that lease money, well, then we start exchanging it and reducing the prepaid expense asset and recognizing expenses at that time. I hope this stuff is starting to ring a bell and refresh your memory. Vehicles, I think, are pretty self-explanatory, and inventory, which is a big one. We'll be dealing with a lot of inventory in this semester. Inventory, remember, is a specific type of asset. It's tangible goods that we purchase and sell. So merchandising companies would have inventory, whereas service companies would not. Also, what we're going to be dealing with is manufacturing companies. But remember, when we first go out and purchase inventory, let's say for cash, to make the example simple, our company now has another asset of inventory or merchandise inventory, which we plan on selling in the future. It will provide our company with a benefit in the future, and that we'll be able to generate revenue and sales and get some money or other goods in exchange for that inventory in the future. Liabilities, well, remember, this is what the company owes to everyone except for its owners, right? Everything except equity, which we owe to our owners. So accounts payable would be the inverse, basically, of accounts receivable. If a company has billed us and we owe a company or any sort of entity that is not an owner, we would have an account payable. Note payable is pretty specific. That's when we sign a promissory note, which is a legal document promising to pay something back. You'll generally see these in loans from banks or more formal loans as opposed to general business relationships which just have ongoing accounts. Unearned revenue is, remember, when a customer pays us for services or goods, but we have not yet delivered the goods or delivered the services. It is a liability. We owe them either goods or services if they have paid us in advance for those. So for the time being, for a temporary while, until we deliver, it will be unearned revenue. Once we deliver, it changes from unearned revenue to revenue. And there's a slew of other payables, taxes payable when a month accrues, either sales tax, you name it, taxes that will be owed to the government, wages that could be owed to employees during accruals, during the end of the period. We won't be dealing too much with that, but just good to have in mind. And then that last piece of the accounting equation, I've reproduced it here in a little bit more of a complicated fashion. Assets is equal to, remember, liabilities plus this category of equity, right? And equity is made up of these 4 subcategories, which we will discuss. Remember that equity is what the company owes to its owners. And equity is determined by, well, if an owner were to invest money into a company, let's take a real simple example. Company is being opened by its owner and they invest $100,000. That would be owner investment, otherwise known as owner capital. Well, if the company were to shut down tomorrow, let's say, that owner who invested $100,000 would expect to get its $100,000 back, correct? Correct. Take the same example. If the owner were to invest that $100,000, but the very next day the owner takes out $20,000, well, it's now reduced its own equity, right? The company now only owes the owner $80,000, right? It put $100,000 in, took $20,000 out. So that is a owner capital investment is an increase to equity, and any withdrawals is therefore for a reduction to equity. Similarly, if the company goes out and earns revenues, right, by making sales, let's say that the company earns, actually let's keep it simple and make it an service industry for now. Let's say the company provides its services and earns $5,000 of revenue. Well, if the company were to shut down tomorrow, the owner would expect $85,000 if we keep this example going, right? The $100,000 it invested minus the $20,000 that it pulled out plus the $5,000 that the company has earned in revenue. And this is why people invest in companies in the first place, right? Not just to get their initial investment back, but they hope that the company will go out and earn revenue and make them more money and increase the owner's wealth at some point, correct? Correct. All right. And then, of course, just as company revenues increase the owner's equity, well, expenses also decrease the owner's equity. So let's keep that same example, $80,000, right? Owner invested $100,000, took out $20,000. Company went out and earned $5,000, which increased its revenue, right? Owner expects to get $85,000 at some point. But let's say there was $25,000 of expenses as well incurred by the company. Well, that's going to reduce the owner's equity, and now the company is going to have less resources to pay its owner with, correct? So it can expect a whole heck of a lot less. In this example, it could expect $60,000. Total equity at this point would be $60,000 based on these simple examples. So I hope that makes sense and explains and refreshes your memory as to what equity was, and that is that last piece of the puzzle. And remember, we've broken equity down into its smaller categories here, but each type of account will have hundreds, possibly thousands in the real world of sub accounts, right? General ledger accounts. There could be thousands of different asset accounts for every asset that is owned by a company. Similarly with liabilities, same thing with expenses. These things can get very dense and very large. Now, in our examples, we will keep them small as we introduce concepts, but in the real world, obviously, companies can have thousands, if not tens of thousands, of different types of accounts. All right, and we'll continue on with the principles of accounting in the next video. Let's go ahead and break this up as this video is getting close to 15 minutes and I like to keep these things short. We'll see you in part 2 of Review of Financial Accounting.